2024 could be a horrible year for the dollar. In fact, that's my forecast. I think the dollar is going to drop 10, 20% in 2024. There's no way that inflation is going to come down in an environment where the dollar is that weak. And investors are going to understand this now, that inflation is never going back down. It's going to keep going up. Our budget deficits are not going down. They're going to keep going up. Our trade deficits aren't going down. They're going to keep going up. All of this is a big negative for the dollar, which is a big negative for bonds.
The dollar was headed for a 2% loss this year against a basket of its peers, marking its first yearly decline since 2020. The dollar index, which gauges the US currency against 6 others, fell by 0.48% to 10.98, hitting its lowest point since July 27th. Economist Peter Schiff's 2024 outlook paints a bleak picture for the dollar, forecasting a substantial depreciation of 10 to 20%. Schiff is convinced that investors will soon grasp the persistent rise in inflation driven by growing budget and trade deficits. Bonds experienced a fourth quarter rally, saving them from a third consecutive annual loss in 2023 after a disastrous decline the previous year. The late-year surge followed treasuries hitting their lowest levels since 2007 in October. Despite bond struggles, stocks enjoyed a year-end rally, with the Dow Jones Industrial Average achieving another record close. The S&P 500 rallied over 24% for the year, approaching its record close from January 3, 2022. The Nasdaq, dominated by technology stocks, is on track for its best year since 2003. Climbing by 44.2%. Peter Schiff suggests that the surge in stock prices is linked to investor optimism about an upcoming rally in the bond market. This optimism is grounded in the belief that the Federal Reserve will revert to zero or near zero interest rates and reintroduce quantitative easing measures. Despite the Fed's efforts to curb inflation, the annualized rate dropped from an alarming 9% 18 months ago to 3.1% at the end of 2023. Peter argues against the market's belief that inflation will decrease to 2%, emphasizing that it's unlikely to reach that level. Now, let's delve into the details presented in the video.
That stocks, the Dow hit an all-time record high. We had Nasdaq hit a record high, right? Big rise in stocks. So while bonds didn't recover any of last year's losses, the stock market recovered all of last year's losses and then some. And so that just shows you how expensive the stock market is relative to bonds, because bonds have gone way down and stocks have gone in the other direction. Stocks have gone up. Now, why have stocks gone up even though bonds have gone down? Because stock investors are anticipating a big bond rally. That's what they think. The Fed is going to go back to zero or close to it, back to quantitative easing. And so they're factoring all this in. They're pricing this easing cycle into the markets now, and they're betting on it. Well, I think they're making a very bad bet because they don't understand what is going to be happening. And they still think that we can go back to these good old days of below 2% inflation, at least the way the Fed measures it. And so the Fed, we're going to have lower interest rates or near zero rates again. And that's not going to happen because inflation is not going back down to 2%. It's just not going to happen. Now, sure, we have had an improvement in the inflation from the worst levels that it got when it was officially up 9%. Sure, it ended the year closer to 3%. But that does not mean that we're going to keep going down. It's very likely that we're banging along the bottom and that we're going to reaccelerate in inflation. It's far more likely that inflation is going to end 2024 higher than it ended 2023 on a year-over-year basis. It's far more likely that that's going to be the case, but the stock market has completely discounted that possibility to zero. The stock market is betting that inflation stays low, or it's just in betting that the Fed doesn't care about inflation because it's betting on all of these rate cuts bringing bond prices down to justify already elevated stock market prices. But it's far more likely that inflation goes the other way. I mean, the big reason that inflation came down, one, it went up so much, and everything ebbs and flows. You're always going to have, some cyclicality. So you're going to get a big move, and then it's going to pull back. But one of the main reasons that inflation came down was the dollar, the strength of the dollar. The dollar index rose from about 90 to 115. And that was, 2021, 2022 increase. That's what brought down oil prices. That's what brought down commodity prices. That brought down the headline CPI. And so that's gone. The dollar's not going to be going up anymore. The dollar's going down. It's already reversed.
In November 2023, the U.S. trade deficit saw a slight increase, reaching $90.3 billion. This rise was accompanied by a $6.2 billion fall in exports and a $5.5 billion decrease in imports. These substantial deficits, according to Peter, signify a weak economy and are anticipated to exert significant pressure on the dollar, particularly in 2024 if the Federal Reserve opts for rate cuts. The Federal Reserve's current dovish stance, especially in contrast to other major central banks, has led to increased expectations of a rate cut in March. This sentiment grew after Federal Reserve Chairman Jerome Powell unexpectedly adopted a dovish tone at the December meeting, projecting a 75 basis points easing in 2024, as reported by Reuters. The Fed's dovish pivot in December has strengthened the case for the continued weakening of the dollar into 2024. Despite this, Peter highlights that the strength of the U.S. economy could act as a limiting factor for the greenback's decline. He points out that, despite the prevailing belief that the Fed successfully prevented a recession in 2023, there is a looming possibility of an even more severe recession in 2024. Now, let's turn our focus to the details presented in the accompanying video.
We got another trade deficit number this week. We got the November number. That was a horrible number. It was $90.3 billion deficit. It's a big number. It was worse than expected, which was $89.6 billion. It was worse than the prior month at $89.8. And what's also bad is how we got there. There was a 2.1% drop in imports and a larger 3.6% drop in exports. And so the deficit got bigger. That's a sign of a very weak economy. But these big trade deficits are going to weigh heavily on the dollar, I believe, in 2024, especially if the Fed is cutting rates. So with rising trade deficits and a weakening dollar, import prices are going to go back up. And when import prices go back up, headline CPI is going to follow. So the markets have got this completely wrong as far as inflation. In fact, if you look at all of the financial news stories at the end of the year, everybody is congratulating the Fed. Everybody's saying this, they did the impossible. They stuck the landing. They got the soft landing. They didn't cause a recession. They restored price stability. They did what nobody thought they can do. I was reading an article in Yahoo Finance about how the recession that everybody just assumed was coming, how we avoided it. As if we avoided it for good, like we dodged a bullet and now everything is fine. We didn't avoid the recession. I mean, first of all, we had one, except they didn't count it because they didn't count those 2 quarters of negative growth. But I know people were looking for a bigger recession, so was I, and we didn't have it in 2023. But that doesn't mean we're out of the woods. We could easily have an even worse one in 2024. So we've got 2 possibilities on inflation, right? Either the consensus is correct and inflation keeps going down, or I'm correct and it goes up. Let's just discount the consensus for the purpose of my analysis, and let's say I'm right. Inflation goes up from here. There are 2 things that the Fed can do in the face of that changing economic data. Powell could come out and say, we expected lower inflation, and it was based on those expectations that in my December meeting, we said that we were going to cut rates, and we indicated that rate cuts were coming, and the dot plots indicated rate cuts. But that's when we were under the impression that inflation was coming down. But now that we're faced with a different reality, now that we see inflation heading higher, we're going to have to take those rate cuts off the table. And in fact, we're going to be raising rates some more. And so we thought that 5.25, 5.5 was going to be the peak. Now we don't know. Rates might have to go quite a bit higher because it's clear that we didn't quite kill inflation yet. It's come back and we have to fight harder, right? That's one thing that Powell can do.
The Federal Reserve, Fed, has consistently emphasized its objective of maintaining an annual inflation rate of around 2%. This target closely aligns with the inflation rate observed before the pandemic. However, the Fed's stated goal prompts a natural question. Why settle for a 2% inflation rate? Why not aim for zero price inflation? Or even more ambitiously, why not set a goal of negative inflation, signifying a scenario where prices are actually falling? This inquiry raises considerations about the Fed's chosen balance between economic stability and potential risks. While a 2% inflation target is often seen as conducive to a healthy economy, the question encourages a reflection on whether a more aggressive approach, aiming for zero or negative inflation, might offer additional benefits or drawbacks. The invitation for input suggests a desire for diverse perspectives on the Fed's inflation target and the broader economic implications of such a goal. It prompts individuals to share their insights on the potential consequences of aiming for different levels of inflation and how these choices might impact various aspects of the economy. And that's it for this video. Let us know your thoughts in the comments down below. Thanks for watching till the end. Before you go, make sure to like and subscribe, and click the notification bell to trigger YouTube's algorithm and see more of our videos on your homepage. Thanks for watching, and see you next time for more interesting videos like this.